Welcome, everyone. It is time for Managing Student Loans Repayment Strategies that Work. For any of you that don't know me, my name is Jessica Medina. I'm a lawyer turned accredited financial counselor. You'll hear a little bit about me, but today is really about you. I want to give you the tools and the frameworks that you need to think about your student loans and get some comfort and clarity on what the best repayment strategy may be. We've had so many changes over the past few years with respect to student loans and some really big ones that happened this year. So we're going to go through what all of that means, and you're going to be able to ask your questions about your loan situation right here today. And I've got something special for you just for attending this webinar. So let's dive in. Again, hello, I'm Jessica Medina, a lawyer turned accredited financial counselor. Now, sometimes it's easier for me to explain what an accredited financial counselor does not do rather than what we do. We do not give investment advice, we don't give tax advice, we also don't give legal advice, even though I am a licensed attorney. But as an accredited financial counselor, I'm here to help my clients figure out some of the more foundational aspects of money management. I help them with managing their cash flow, paying off their student loans, paying off any other debt that might be lingering. And I also help specifically my clients plan for big life transitions. So if you are in the midst of a potential career shift, if you are growing your family, if you're about to become an empty nester, or you have some other life transition that's happening for you, I help my clients think through the financial pieces and the emotional pieces so they can make those moves with confidence. And I do that through private coaching, working with my clients one-on-one. I also offer speaking engagements and workshops for legal organizations, anything from law firms to bar associations to law firm alumni associations, and trying to get into those law schools, because if we can fix these issues early, it really makes a huge difference. So if you are connected to anyone who organizes that type of programming for any legal organizations, please reach out. I would love to be able to give a program like this to your folks. I've done it for a number of bar associations and law firms, and I think people underestimate how stressful student loan debt can be, especially for attorneys. And I like to bring some clarity with these workshops and give people an idea of how they might be able to approach them. So just in terms of my student loan story, I graduated from Columbia Law School way back in 2004 when the student loan landscape was very different. And I graduated with over $200,000 in student loan debt. As you can imagine, that really affected my career choices moving forward. We did not have the same type of forgiveness programs that we have now. And so I knew that the only option I had, especially as a single mom, was to just go into big law. I needed to get a firm job, whether or not that was my passion. And I decided that I would do that and to, be able to at least support my family and maybe make some sort of dent in my student loan debt. But I really didn't know what I was doing. And I didn't feel like there were a lot of people out there who had a good idea of what I should be doing. So it took me quite some time. As you can see, I've done some of the inflation adjustments, and that would have been a roughly $334,000 of student loan debt today. Now, I have clients who are facing that amount more, sometimes less, but this is a reality for so many attorneys. And, in terms of kind of how we need to approach student loan debt, what I find is that in the personal finance industry, they don't necessarily appreciate the amount of debt that we may be graduating with. The typical American graduate has roughly $35,000 of student loans, but the typical law school graduate has something closer to $145,000 in student loans. And that's the average, right? As you can see, folks like me, we enjoy being above average, and we may graduate with way more than that. And so we need better strategies than just paying things off as quickly as possible. We need to understand the entire landscape, what all of our options are, and where we are on our own personal financial journey to determine the best repayment strategy for us. So that's the work that we're going to be doing today. There are a lot of nooks and crannies that we want to be going through. So that's why I reserved 90 minutes for all of you. But my hope is that you will have enough information today to be able to think through the best plan for you and get all of your questions answered so that you really can take action and feel confident moving forward. So today we're going to be going over a number of issues in the student loan world. I'm going to cover some student loan basics just to make sure we're all using the same terms and we all understand what our student loans actually mean and what kind we have. We'll talk through the different repayment strategies that are available and when each one might be a particularly good fit for you. I'm also going to talk about the current stance in terms of being stuck in the SAVE program. If you switched into the SAVE repayment plan or you were automatically moved into the SAVE repayment plan, you are probably feeling a bit stuck and might have some questions. So we're going to talk about that specific situation as well. I will touch on options for default to the extent that anyone right now might be really behind in terms of payments or maybe have been ignoring everything going on in the student loan world for fear of doing something wrong. We'll talk through that. And then, of course, making your own plan and making sure that we reserve some time for questions. What I will ask is if you do have a question that feels relevant, for the topic area that we're covering, I'm going to be taking a couple of breaks during the presentation. So you can just pop your question into the chat, but please put question in all caps so that I can scroll through and easily find the important questions that we want to make sure we cover. I also have a special resource for all of you who signed up for today's webinar. I am going to be offering Voxer office hours. If any of you are familiar with this technology, it's kind of like a walkie-talkie. It's a push-to-talk app, and you can record audio messages, you can text messages back and forth. This is something that I've used with some of my clients, and it really helps in terms of getting some real-time feedback to the extent I'm not able to answer all of your questions right now, or you need to go look up some stuff to figure out what your status actually is. So for everyone who came to the webinar and who registered, I'm going to be offering those office hours this Friday, October 3rd, and also this Monday, October 6th, giving you the weekend to track down anything you might need in order to kind of have a good back and forth with me. As I said, you can send a text, a video, or an audio message, so you don't necessarily have to type everything out. You can just chat to me and tell me what your situation is. And if you are on the Voxer app on Friday or Monday, I will be on there as well in real time. So we can actually go back and forth, and I can ask you some follow-up questions. You can send me some responses. We can have a little bit of a back and forth, which is sometimes really necessary to get to the bottom of what might be the best repayment strategy for you. So just make sure that you download the Voxer app and use code word SLRP when you're starting your message to me. I get a lot of weird Voxer messages from numbers I don't recognize. So use that code word so that I know that you were here or you at least registered and maybe watched the recording so that we can start having our conversation and I can help you figure out what's going on with your student loans. So again, the link is down at the bottom. You guys are going to get all of this information in a follow-up email along with the recording. So you'll have this, but I did want to make sure I mentioned it early on, just in case you have to hop off or you don't have a chance to kind of pop your question into the chat today and wait for the answer. You will have an opportunity to get my brain on your situation if you reach out to me through Voxer. All right, I think we can finally dig into some actual student loan basics. So one thing that I always want to make sure my folks have a good understanding of, right, just to start is what kind of loans are you carrying, right? Do you have federal student loans or do you have private student loans? If you know what kind of loans you have, pop them in the chat right now. Just put federal or private or put both. I would love to get a sense of kind of who's here and what kind of loans you might be battling. Yes, I often see a lot of folks with federal loans, which can sometimes be even more confusing than the private. Oh, yes. Oh, okay. We've got a lot of federal loans. This is great. Federal loans have a lot more strategies available to them than private, but we are going to be talking about both. So just to confirm, right, federal student loans, these are loans that are owned by the U.S. Department of Education, right? So there have been many different names of these programs over the years. So if you have anything that is called a direct subsidized, a direct unsubsidized, a direct plus, including grad plus, direct consolidated, even if you had some of these older federal family education loans, I had FFEL loans, they were called Staffords back in the day. Those are also they are guaranteed by the U.S. Department of Education, so there might be some tricky stuff if you haven't converted them to direct, but the vast majority of my clients generally have mostly direct loans, whether they're grad loans or undergrad loans, they're all federal loans. Also, to the extent that you took out any Perkins loans for undergrad, those would be considered federal loans. And the best way to figure out how many federal loans you have, what kind you have, is the information available at studentaid.gov. I will say the federal government doesn't always do a great job of providing information through websites and through general access portals. However, the studentaid.gov website is the best of the best. And before all of the tumultuous changes happened and before the Department of Education was gutted staff-wise, this website was a font of information and lots of helpful tutorials, FAQ sections, calculators. There really are a lot of resources on studentaid.gov. It is still the #1 source for information about federal student loans. And so I do suggest that if you have not already, make sure that you have a profile on studentaid.gov. You might have to provide some identifying information if you haven't signed on there in a while, but that's going to be an important step in identifying all of your federal student loans. Now, the other types of student loans that exist out there are private student loans, right? So this is basically everything that is owned and serviced by private student loan lenders, banks, right? So anything that you took out as a bar loan, right, after you graduated, that would be a private student loan. If you needed more money for law school than was allowed for the cost of attendance, which is basically what you're allowed to borrow in terms of grad plus loans, then you may have taken out a private loan on top of your federal student loans for additional living costs, right? Or if you had any other expenses coming up while you were in law school. And so private student loans, in order to figure out, right, how many do you have, who's holding them, you can certainly check any communications you've received from student loan service providers, stuff that you've gotten in the mail. Now, if you have moved several times, or if your service providers themselves have actually shifted and maybe gone out of business, or at least gotten out of the federal student loan game or the private student loan game, then you can also check your credit report. Your credit report will have all of your loans, both federal and private. So it's a great quality check to make sure that you have the full universe of loans that you may owe. And so, oh, I love seeing the chat. Yes, everyone, solidarity all around. Student loans are the worst. But oh, I do. I also see some federal. And oh, but you consolidated your FFEL. Benita, that's actually not necessarily a bad thing. And it might be worthwhile to ask a question when we get to the specific Q&A period, because those FFEL loans were treated differently, but converting them to direct loans gives you a lot more options in terms of your repayment strategy. So I had a lot of clients during the pandemic that converted their FFEL loans, and they have been very happy with the results. So it may be a good thing. We'll double check to see. But back to the private student loans, right? Again, checking your credit report is a great place to make sure that you've captured all of your student loan debt and you know who to communicate with in terms of potential repayment strategies. So now that we know what kind of loans everyone's dealing with, and I'm scrolling through the chat, and it looks like everybody pretty much has federal student loans. Okay, all right, amazing. Um, to be fair, federal loans are definitely the more complicated of the two because the rules keep changing, because they're usually the larger amount, and because the Department of Education isn't always so great about communicating how you need to pay them off, and student loan service providers have been absolutely terrible in that regard. So I'm not surprised to see a lot of federal loans, and it does give me hope that we might have some creative solutions for you. Certainly things to think about and deadlines to watch out for. So this is great to have all of you together. And again, you can be in solidarity. Everyone is struggling with federal student loans. It's not just you. So let's get into those repayment options. When it comes to law school loans, right? And this includes undergrad loans as well, right? It's basically anything related to student loan debt. There are three basic repayment strategies that you can use to approach your debt. There is the repayment ASAP method, right? This is the one that you hear so much about in the personal finance world. Pay off those loans as quickly as possible. All debt is evil. Student loans are the worst. You're responsible for them. That's that bucket. And when you're going for repaying your loans as quickly as possible, right, we're basically aiming for you spending the least amount of time paying off your loans. And that usually results in the least amount of money coming out of your pocket, right? That's the hope. With respect to the second bucket, we are thinking about forgiveness programs. Now, if anybody had said, oh, I have private student loans, forgiveness programs would not apply, right? These forgiveness programs are designed for forgiveness of federal student loans. Now, there may be some state programs or other, employer-sponsored programs or otherwise that could potentially apply to private student loans, but generally speaking, forgiveness is really reserved for federal student loans. So all of you could qualify for forgiveness at some point, and we will figure out if that's something you want to consider. When you are aiming for forgiveness of your federal student loans, you want to aim for the lowest payments possible and then having the largest balance forgiven at the end of the line. This is a bit of a juggling act over the course of your career, and they have not made it easier with some of the changes to the student loan landscape. But forgiveness is available. It's available to absolutely everyone. You don't necessarily have to work at a particular type of employer, but you do have to pay for a certain amount of time, and you do have to have a certain number of payments right under your belt to be eligible. Lastly is what I call the repay your way strategy. This is basically a combination of whatever strategies you might need to deploy at whatever point you are on your financial journey. It's not a cookie cutter approach. It really does try to aim for giving you the most flexibility over your entire financial journey. Because what I often find is that the repayment strategy that you pick earlier in your career may not make sense depending on what happens with your career. I've had clients who started out in the public interest world and then left that world. So getting, public service loan forgiveness doesn't really work for them anymore. So with the repay your way ideology, right, we're really thinking about how can we remain flexible with our options, not close off too many doors that we might not be able to reopen, but also allow us to live our life and continue on our financial journey. So we're going to talk about all of those repayment strategies today. So in terms of kind of a back of the envelope, how do I get started with these types of strategies? The guidelines, there is a little bit of math involved, right? But this is really just kind of a stress test. If your gross annual salary is larger than your overall student loan debt, then you want to consider the repayment ASAP method. The reason is that if your salary is larger than your overall debt load, you likely will not qualify for forgiveness because you won't pay for long enough. You will pay off your loans before you reach forgiveness. And so, given that, there's also an understanding that maybe you have some extra money that you could throw toward your student loan debt to get rid of them a little bit faster. So, we want to examine that. But I do want to give the disclaimer. All of these guidelines are just the first step in determining which strategy is a good fit for you. Just because your salary is larger than your overall debt does not mean that you should automatically start, implementing the repayment as soon as possible method. There may be a world in which forgiveness still makes sense for you, or that, taking a more flexible approach makes sense. But this is the starting point. Okay, and then the second bucket, in order to be a good candidate for forgiveness, now, under the new rules, we really need to see your debt being greater than 2 times your gross annual salary. It used to be lower, but they've changed the programs and they've changed the timeline for forgiveness. So now that it takes longer to get to forgiveness, we have to shift kind of who is a good fit and who may not be a good fit. Again, a caveat for forgiveness programs, because I imagine, and because I know some of you who are on this webinar, if you did not just graduate from law school in the past year, you may have some payments under your belt that will count toward your forgiveness timeline. And so the debt being greater than 2 times your salary might not necessarily be the right ratio for you because you already have some forgiveness credits under your belt, which means it won't take you the full time frame to get to forgiveness. And in that case, we are going to have to do some more calculations to figure out what is your personal journey. But I don't want you to feel like, oh my goodness, well, I don't have that much debt, and so I might not be able to qualify for forgiveness. You might. It just depends on how long you've been paying. And then lastly, of course, right, if you are in between those two guidelines of salary being greater than your debt or your debt being 2 times your salary, then we might need to get creative. And we might need to explore a number of different strategies, possibly deploying them at different points over your financial and career journey to make sure that you can manage your student loan debt and also eventually get them taken care of, whether that's through forgiveness or through actually paying them all off. So let's dive in. I know everybody has federal student loans. Even if you have federal student loans, you might end up deciding that paying them off as quickly as possible makes sense for you, right? And so, as we discussed, with the repayment as soon as possible method, we want to aim to keep your total cost low, right? So, over the entirety of your repayment journey, you want to pay out the least amount of money. That basically means that we want to be, kind of lowering the amount of interest that you're paying, and hopefully getting through the principal on your student loans as quickly as possible. So, what are some tools that help us do that? What do we want to be thinking about? What if we are considering repaying our loans as quickly as possible? You may need to refinance. Because all of you have identified that you have federal student loans, you probably have interest rates that are less than palatable, right? Federal student loans, unfortunately, especially graduate student loans, tend to have pretty high interest rates. It all depends on what year you took the loan out, right? So, depending on when you were in school, when you were borrowing the money, that is what determines your federal student loan rate for each individual loan. And that rate is set for the life of the loan. There is nothing that you can do to change it if you keep that loan federal. So, oftentimes, when people are looking at actually paying off their student loans, right, in their entirety, they want to look at refinancing. So, you can secure a lower interest rate on the balance of all of your student loans, because that will lower how much money you're paying over time, or to get rid of the loans. But you will have to refinance them, and we're going to talk about the difference between refinancing and consolidation. But refinancing basically means you're going to take your federal student loans and convert them to private. I'm going to say this probably several times during the presentation. That is an irreversible move. You can go from federal to private, but you can never go back to federal. So before you make a decision to refinance your federal student loans, you want to be very careful that that is the decision that makes the most sense for you, and you're going to be able to handle those loans for the entirety of the payoff timeframe. Also, when you're refinancing, that means you're working with a private bank. They're going to, give you a bunch of money to pay off the loans, and they're going to give you a new loan, a private loan to pay, that you'll be paying them off with. So that's going to require a credit check. And so the interest rates that you qualify for out on the open market will vary depending on what's happening with interest rates generally. We just saw the Fed drop interest rates, so they're going in a good direction for student loan borrowers who want to refinance. But it will also depend on your personal credit score, and what interest rates you can qualify for. So that's something to take into account if you're thinking about, getting your loans paid off as quickly as possible. Also, you want to be thinking about income security. It's very important that when you refinance, especially federal student loans to private student loans, that you're paying attention to all the benefits that you could lose. Private banks are not as generous when it comes to hardships, when it comes to job loss protections, when it comes to different types of repayment plans. And so you do want to be careful, that although you might save money in the long run with respect to interest savings, you will lose some of those key benefits that are meant to protect you when you have federal student loans. Banks are not as giving and caring when it comes to those types of economic hardships. So you might need to be making payments on your student loans, even if something happens to you with respect to the rest of your economic situation. So that's something to pay attention to. If you believe that you will be in, the same job for, the next 20 years and you have very good income security, then this could be a good option for you. I will say there are some sectors of the economy that I used to believe were very secure, and they no longer are. So none of us really have a crystal ball in terms of income security, but it can certainly, refinancing can certainly lower your total cost. Lastly, you want to be thinking about your own lifestyle. And I'm not just talking about, vacation money, eating out money, shopping money. I'm talking about mortgages, daycare, right? Basic necessities. Many of my clients live in major metropolitan areas, and their lives are expensive. And repaying over $100,000 in student loan debt is going to carry a large monthly payment. especially if you are trying to refinance to a short time frame. That's going to be a really big monthly payment that's going to eat into your monthly cash flow. And you want to make sure that you're not, taking on too aggressive of a refinance payment schedule because again, you won't necessarily have the protections, right, with federal student loans if you refinance them. And if you refinance them into a super short aggressive time frame and you miss a couple of payments, that's going to then affect your credit, which will make it harder for you to qualify for a new repayment plan. So these are things that we want to be thinking about before we make the decision that, yes, I want to pay off my loans as quickly as possible. In terms of a guideline, you want to aim for no more than 10 to 15% of your gross income going towards student loan payments, right? That's a good barometer in terms of like, that's just money going towards straight debt. Right? You need money for other things in life. So if your monthly payment is going to be above 15% of your gross income on the repayment schedule you've chosen, maybe pick a different repayment schedule or consider not refinancing at all. Right? We want to make sure that we take care of student loans, but we also want to make sure that we take care of you. I want to mention with respect to the repayment ASAP method, there is also an emotional component to this. I have plenty of clients who are willing to stress themselves out financially in order to get the student loans off of their back. Now, sometimes when I do this type of analysis with my clients and I show them how we can still get everything paid off or forgiven and they get to live a life while they're doing that, they may make a different decision. But I'm not here to tell you that you should take as long as possible to pay off your student loans. I'm also not here to tell you that you should do it as quickly as possible. There is a spectrum of options available in between, and I just want you to take your emotional component into account when you're deciding on which repayment strategy makes the most sense for you. So, what are some tools that can help make repayment easier? These are two terms that sometimes people confuse or terribly interchange when they're talking about student loans, and they are actually very different. And so, for clarity, consolidation is a process within the federal student loan world that takes multiple federal loans and then combines them into one new federal loan. Many of you may have been advised to consolidate all of your loans when you graduated from grad school, and you may have, kind of put all of your undergrad together and all of your grad school loans all together into one huge consolidation loan. That is still a federal loan, and so really, what happens is there's isn't it's not really kind of like an interest rate game. What happens is they take all of your federal loans and they give you the weighted average interest. So they'll take, loans of different balances with different interest rates, and you will end up with a consolidation loan that has the weighted average interest. And so you will basically pay the same amount of interest over the life of the loans, but now you'll just have a single interest rate rather than a spectrum of interest rates across all of your loans. This process can also convert undergraduate loans into graduate loans if they're consolidated. That is not as big of an issue as it used to be under some of the repayment plans, but you do want to watch out for that. You can just do two consolidations. You can consolidate all of your undergrad together into a single consolidation loan and then consolidate all of your graduate school loans into a single consolidation loan. So that's one way to retain the nature of those loans. When you consolidate, you still have access to federal repayment options. So it doesn't take you out of the federal loan world. You just have a new federal loan. And we talked about the weighted average loan payment count. We talked about the interest. We will also be speaking today about the income-driven repayment payment count adjustment that the Department of Education did over the past 18 months. If you are doing a consolidation now, they will take all of the past income-driven repayment eligible payments and they will give you the weighted average loan payment count. So your new consolidation loan will not reflect the highest number of payments that you've made previously. It won't reflect zero, but it will reflect some sort of weighted average in terms of, kind of the payment count. So that's also something to think about. But the most important warning related to consolidations right now is that if you consolidate your loans after June 30th of next year, right, June 30th of 2026, you will be limited in terms of what income-driven repayment options you are not eligible for. Any loans that are created after June 30th of 2026 will only have access to the new kid on the block wrap, which we're going to talk about later, and standard repayment options. So if you are currently in any of the other income-driven repayment plans and you like the plan that you're in, you want to be very careful about consolidating your loans next year or taking out any new loans next year, because that will knock you out of eligibility for these older income-driven repayment plans. Now, with respect to refinancing, right, we talked about that this means that you're working with a private lender and they're basically going to pay off your federal loans, give you a new loan that they service, and put you on a repayment plan. And so this is a new loan. Again, it is no longer a federal loan. Now it's a private loan. This is an irreversible decision. So you do want to be very careful. And there will be income and credit requirements, right? Banks like people who have good credit. They like people who make good money. And so the type of loan and repayment options you qualify for will be a reflection of some of those factors. You can often get access to a lower interest rate on the private market. I don't know why the federal government is trying to suck all of us dry with their usury type insurance interest rates. However, on the private market, you usually can get a better rate for a lot of your loans, especially if you happen to take out your loans when they were offering 7%, 8%. I've seen stuff as high as 8.5. That's a really high rate for a loan, and you can absolutely get a lower interest rate in the private world. We just need to make sure you can handle it. But because as we said, you will lose those access to the federal protections and to forgiveness. We talked about, right? Forgiveness does not apply to private loans. So this is really only a strategy if you're planning on paying off the balance of your loans in their entirety. But if you are, then this can be a powerful strategy to save you money over the long run and give you some flexibility in terms of your repayment options. Oh, great. Oh, good. We have questions coming in. Ah, yes, Benita, you're so good. If there was a magical time where you could consolidate your federal student loans into a new federal loan, and if you did that between April of 2022 and June 30th of 2024, you received the best treatment in terms of your eligible payment count. And I will be talking a little bit about that payment count adjustment. But yes, if you did it during that magical time period, then the consolidated loan should reflect the highest number of payments on any of the individual loans that are part of that consolidation. It was an extremely powerful move. They offered it for a limited time, and some of my clients that took advantage of that have already had their loans forgiven. So it really is powerful, and it's something you want to be double checking to make sure that you're getting all the credit you deserve. So let's go through a client example in terms of the repayment as ASAP, right? Just something to think about in terms of how to maybe approach some of these numbers. I had a client who he had already refinanced his federal student loans before I met with him. So this wasn't unfortunately something that I got to advise on before he did it, but he had refinanced $210,000 in December of 2024. And we were working earlier this year on figuring out, do we want to do something different with his loans? He was a mid-level associate at an AmLaw 100 firm, so he had a very good salary. He was on a 10-year repayment term at 5.69%, which was much better than what his federal student loans had been sitting at. But his monthly payment was roughly $2,400 a month. And that was something that he could absorb in terms of his gross salary. But he was also trying to attack credit card debt, buy a new home, and ramp up his investments. And that $2,400 payment was really making that difficult. And so we looked at some refinancing options for refinancing his refinance loans, right? Once you have a private loan and you've refinanced, you can refinance as many times as you want. You just want to make sure that you're not paying more in transaction costs than you're saving in terms of, potential savings with interest or with better payment plans. So we looked at some refinancing options for his already refinanced private student loans. At a minimum, we could look for lower interest rates, right? Keep him at 10 years, but get the lower interest rate because the rates were even better in the market earlier this year. And he was looking at something in the range of about 4.4%. That was going to be over a point drop in terms of his interest rate. That's usually a good marker for when you want to consider refinancing. And so even with the same 10-year plan, he would have brought his $2,400 payment down to roughly $2,000 a month, right? So an extra 300 bucks that he could throw at stuff. He would also be paying less interest just because this is just money that goes to banks, right? It's just the interest rate. We always want lower interest. That's just bank money. But we also looked at extending his repayment term in combination with a lower interest rate. So a 15-year repayment term, right? So taking 15 years instead of 10, but still dropping his interest rate to 4.4%, that was going to drop his payment to closer to $1,500 a month. That was closer to $900 a month in savings that he could throw at other financial goals. Now, because of the longer repayment term, he was on schedule to pay $18,000 more in interest over the life of the repayment, but there's nothing saying that he has to take the full 15 years to get this done, right? So we want to be thinking about your cash flow needs now versus in the future, other financial goals that you may have, and the potential of early payment options, right? They generally speaking, if you refinance your student loans, there is not an early payoff penalty. They're not going to hold you to the 15 years. If you want to throw extra money at it, you can get that stuff done early. So you want to be paying attention to both the interest rate and the repayment term to find something that fits for your current financial situation and that you'll be able to manage over the entirety of the repayment term. Now, you also want to be looking for sign-up bonuses. So a lot of these banks, they especially love lawyers and they want your loans. So if you're going to be refinancing, whether from private to private or refinancing from federal to private, definitely make sure you're looking for sign-up bonuses. You can get upwards of $5,000 in terms of a sign-up bonus to just kind of knock money off of the principal of your loans. So why not? We like free money, right? And then just kind of looking through how could this potentially play out? What could happen in those 10 years? He could take that $880 per month and throw that at his credit card debt, making more aggressive payments and getting that stuff taken care of. He was also shopping for a new home. And one thing that I'm always thinking about for my clients with respect to if they're trying to get into a home or if they're trying to, buy a car, the creditors are going to be looking at your debt to income ratio. They're going to be looking at how much of your salary is going toward monthly debt payments. And having a $2,400 monthly debt payment on your balance sheet versus a $1,500 monthly debt payment on your balance sheet really changes how much mortgage you might be able to qualify for, what kind of home you might be able to get yourself into. So these are important considerations when you're thinking through your repayment journey. Yes, student loans are stressful and a lot of people have them front of mind. That's why you're here today. But you are also doing other things in your life, and all of these things interplay. So we want to be thinking about what are all of the potential consequences of shifting your repayment strategy. And maybe there's a strategy that will work very well for right now, and then we will shift into something that's more aggressive later when you have more cash flow available, right? And so thinking through if he had spent 10 years on that lower payment, then he would have had a loan balance of now 85,000 instead of the 210,000. And if he had just been saving that money in a high yield savings account, he actually would have had plenty of money to pay off the entire balance. So it's a funny quirk of, right, how all of these different factors can interplay, but it's something to think about if you are considering refinancing or exploring a refinance strategy. Make sure you're paying attention to those interest rates and your repayment term and picking a strategy that works for you. So we're gonna have to stay tuned. We're still working together, and he is, thinking through whether he wants to, continue shopping for better rates. We are mapping out a move to San Francisco. We're also mapping out a future European vineyard. There's a lot of pieces moving around. But when I said I work with people who are thinking about big transitions, these are the transitions we're talking about, right? We'll see. We'll see what he ends up doing, but I anticipate he may end up going for a longer repayment term, especially as these interest rates keep dropping, so that he can really attack some of these short-term goals, and then he'll just get super aggressive and get that knocked out well before the time frame's over. So let me pop into the chat and see what questions have come up. And if they're not questions specifically on the repayment ASAP, that's okay. But we are going to go through all of the forgiveness options shortly. So I also don't want to, kind of confuse people by answering the questions too early. So Benita, I answered yes. If you consolidated during the magical time period, you should have the highest payment count reflected on your new consolidated loans. And okay, if I'm on an IBR program for almost 10 years, you recommend that I continue that plan. Ooh, you have 10 years under your belt, Prima. So there's going to be some math involved, but thankfully there are some calculators that can be helpful. And I'm going to be sending out links to the calculators that are helpful. I think if you have been on the IBR program for at least 10 years, you really want to consider that you might be able to ride that out. It really will depend on your outstanding balance and your salary and your career trajectory, but you could have just another 10 or possibly 15 years left to pay. And that can be a reasonable amount of time, especially if we can keep your payments low, where you would still qualify for forgiveness. Okay, charity question. Okay. I also consolidated my Fed loans last year during that period, but it seems like I'm only paying interest on this right now. Curious what I should do to start attacking the principal. Okay, Charity, you might be stuck in the save forbearance. That is generally what's happening to folks who, ended up in a plan that they maybe didn't actually want to be in, or now are just stuck because of what's been happening in the courts. So we'll talk about that when we get to what to do with save. Okay, and does it make sense to make a large lump sum before refinancing from 7% to 3.94 or wait until after refinancing? Oh, Whitney, that is a good question. So if you're taking yeah, okay, from federal to private, thank you for clarifying. If you're taking it from federal to private, lowering the principal is whether you do it under the 7% or the 3.94%. I would probably refinance the full amount unless you can get a lower interest rate for a lower amount, right? So you can ask your refinancing lender what the terms would be for the different amounts, but you're basically going to be able to throw that money at principal under either of the regimes. I will say it might actually be easier to get the money to go to principal if you do it through the private lender because they shockingly have better service than, trying to work through the federal student loan service providers. And there's just been so much confusion on those websites and when people are doing applications and sending payments in, making sure that it gets actually attached to the appropriate loans and goes to principal rather than just moving, your next payment date out, for forever. So if you can get the same terms from the private student loan provider on either the larger balance or the smaller balance, then I would suggest that you do the bulk payment once you're in the private world. It's going to be easier, more streamlined. You're going to have better records. Okay, it sounds like all of the questions that are coming in on the forgiveness programs. So I'm going to dive into forgiveness options with all of you, and we'll take care of all of those questions as well. Okay, so when it comes to forgiveness, there's three buckets of forgiveness in the federal student loan world. There is income-driven repayment forgiveness. There is public service loan forgiveness. That's the one that everybody hears about all the time. And then there are teacher programs. We are not going to spend any time learning about teacher programs today. You can only get roughly 17,500 forgiven anyway, and most of my clients are not eligible because that's just not the job that they're working in. So we're going to concentrate today because it's confusing enough for us to just go through the income-driven repayment and public service loan forgiveness. So let's get some level set on income-driven repayment plans. Again, if you are going for forgiveness, right, the aim is to keep your payments low. You want your monthly payments as low as possible for as long as possible so you can be eligible for forgiveness and have a balance at the end of the road. And just in terms of some terms, right, IDR is the umbrella term for all income-driven repayment plans. So when you see some communication from your student loan service provider that says, "Oh, you're in an IDR plan," it's not telling you which IDR plan you're in. It's just telling you you're in a IDR plan, right? So the IDR plans that are currently available and will be available until July of 2028 is IBR, income-based repayment, both old and new. Yes, there's two versions. Pay as you earn, and ICR, which stands for income contingent repayment. Pay and ICR will expire in July of 2028. So if you will be able to get into those plans up until July of 2028, but in July of 2028, you're going to have to switch to something else. IBR is around. That's our tried and true. It was baked into a statute. It's very hard to change as much as they try. So that is the one that will continue as long as you have the eligible loans. If you are in SAVE, you are currently in forbearance, and you will likely need to switch at some point soon. The SAVE forbearance will end when the courts decide to end it. And so we're all just waiting to see what's happening with the SAVE forbearance. We don't know the exact timing, but when the court says, and we're done, everyone's going to have to switch, everybody who's currently in SAVE. The payments were paused for nearly a year since last summer when the injunction went through, but right now your interest is accruing. So that was the big update in August of this year, that although payments are still paused, they're going to start tacking interest on to your balance. And so, a lot of people are now itching to do something about their status in SAVE because these payments are not being counted. Even if you're making payments, they're not counting toward your forgiveness timeline, and you are now being charged interest. RAP, Repayment Assistance Plan, is the one that is coming soon. This is the new kid on the block, and the new RAP plan will be available at the latest summer of next year, but it's not available yet, so you can't get into it just yet. Basically, this is important because any loan that is issued starting from July of 2026 will only have access to RAP in terms of income-driven repayment plans, which is why it was important to be thinking through whether or not you want to consolidate next year. If you are thinking about consolidating, you very likely want to make that decision before June of next year, because if you consolidate after that, you will be ineligible for any income-driven repayment plan that still exists other than RAP. So again, right, if you're going for forgiveness, we want to aim to keep those payments low. And now just a little bit more about the other plans that are out there. Oh, I just lost my chat. Oh, I will go back in there and find it. Oh, there it is. Amazing. Love computers. Okay, here's some basics for income-driven repayment plans. This is what you want to be thinking about. Right there's eligibility criteria for each one. There's different payments under each one. This is why it gets so confusing, because every few years the federal government decides to create a new income-driven repayment plan, and then they switch the eligibility criteria for all of them, and they also change the way the payments are calculated. So some of the income-driven repayment plans have an income hardship requirement, but really only one does now. They've changed the rules. So the pay-as-you-earn plan, it does require an income hardship requirement. There's a formula for figuring out whether you're eligible or not. There are also loan age criteria for a number of the plans, such as new IBR and pay-as-you-earn. So you do need to check whether you're actually eligible for those different types of loans. You can use the loan simulator on studentaid.gov. You can also, I will be including resources to help you kind of manually figure out whether you would be eligible for that. Sometimes you also can just apply and see if they reject you or not. The payments under each of the plans vary, so that's why we really do want to be comparing kind of what would your situation be under each of the individual plans to make the best choice for you. With respect to forgiveness, all income-driven repayment plans result in forgiveness if you are in them long enough and making all of the eligible payments. And so any balance that you have on your student loans after 20 or 25 years, depending on the plan, that balance will be forgiven. It doesn't matter where you're working. It doesn't matter how much you've paid over those 20 to 25 years. Even if your income was low enough that your payments were zero for the 20 to 25 years, you could still qualify for 100% forgiveness. And so I think this is something that sometimes gets lost in the personal finance world. There are forgiveness options for absolutely everyone with federal student loans. You just may not get there. And that's really the calculation that you have to do. Lastly, you do want to think about tax consequences, because under the income-driven repayment forgiveness, any balance forgiven after the repayment period will be treated as taxable income in the year that your loans are forgiven. So they basically treat it as though the IRS wrote you a check for whatever amount of your loans are forgiven, even though you didn't actually get that money. That money literally just went to the government. That being said, there is a moratorium on federal taxes on any forgiven loan amounts through the end of this year. There is an actual court case right now in the courts trying to figure out, well, what happens to people who should have gotten forgiveness earlier, but because of all the delays and all the processing pauses, it doesn't happen until later. So the courts will be deciding that. Also, just as a practice note, we have never seen what happens when there are actual tax consequences for forgiveness under income-driven repayment. Why? Because it has taken this long for people to even be eligible for income-driven repayment forgiveness. The programs haven't been around that long, so we've been waiting for people to hit 20 or 25 years. Now, and then for the entire window where now people have been eligible for forgiveness, we've been in this federal tax moratorium. We do anticipate here in the student loan world, I would have said this much more confidently last year, that, when people get forgiveness, if they get a big tax bill, there's going to be an uproar, there are going to be lawsuits, and, they will change the rules so that it's not so unfair. I just don't know if that's true anymore because they seem to be rewriting rules to make them more and more unfair as we go. And so, if that is the case, you do want to be saving up for potential tax consequences of any forgiven amounts. That just becomes money that you stick in a high yield savings account, or as part of your long-term investment growth, depending on what is the timeline and that you're waiting for forgiveness. And then you just have that money ready. And if there is what we call the tax bomb, then you pay it with your savings. And if there is no tax bomb, then you go on a cruise and you enjoy yourself. Okay. Other considerations that you want to take into account, the different income-driven repayment plans have different caps to the amount of money that they can charge you over the course of the month, depending on how much money you are making. All of the income-driven repayment plans, the amount that you pay per month is solely based on your income. It has nothing to do with your loan balance. Your monthly payment is just a reflection of how much money you make and potentially how much money your joint household makes if you file your taxes married filing jointly. There are some plans that have no cap in terms of how much they can charge for your monthly payment if you end up making a lot of money. There are other plans that do have a cap. No matter how much money you make, you can never go through the cap. So if you anticipate that your salary maybe is low right now, but it will skyrocket in the future because you're going to own your own law firm or you're going to become general counsel of a Fortune 10 or whatever it might be that's going to result in large income in the future, you definitely don't want to be in an income-driven repayment plan that doesn't have that cap involved. Right. Secondly, we just talked a little bit about tax filing status. All of the income-driven repayment plans now allow anyone who files their taxes as married filing separately to only count their individual income when determining their monthly student loan payment. This is a very important strategy for couples, especially where the high income earner does not have student loans, and maybe the other spouse has a low income but a really large student loan balance. This is one way to really strategize getting your student loan payment as low as possible. This did not used to be the case under some of the income-driven repayment plans, but thankfully they have fixed this issue. And then lastly, of course, because of where we are in the world, things are under review. SAVE is under injunction, and this will likely not survive. Pay and ICR are set to expire in June of 2028. So anyone under those plans will need to switch before then. IBR old and new. This is one of, I think, the more confusing aspects of the income-driven repayment world, but it is going to stick around. So it's important to understand how these two plans work. The IBR is going to be available for any loans that were issued prior to July of 2026. So everyone on this call should have loans that are eligible for the IBR plan. It's just a question of whether you're eligible for old IBR or new IBR. And that is dependent on when you took your first loan out. If you borrowed federal money before July of 2014, you are in the old IBR world. And it doesn't matter if you borrowed after, everything is in the old IBR world. If you took out your first loan after July of 2014, congratulations. You're in the new IBR world, which is nicer than the old IBR world. So you can see underneath kind of how they figure out the monthly payment amounts. Old IBR takes 15% of your disposable income. Disposable income is a formula. And so I'm going to be sharing some resources for how you guys can figure out your specific numbers. New IBR is 10% of your disposable income. So that's a really big difference in your potential monthly payment. Also, the IBR plans do have that cap in terms of the max monthly payment you could ever pay. But there are no interest subsidies. So this is a plan in which you could potentially see your overall balance ballooning over time. However, if you're going for forgiveness, the whole balance will be forgiven. So you shouldn't worry too much about an increase in your balance unless you eventually are planning on paying those loans off. Again, old IBR and new IBR have different timelines for when you are eligible for forgiveness. Old IBR, again, not the best plan. It's going to take you 25 years of payments. New IBR, only 20 years of payments. And then with the tax liability, again, same tax rules apply for IBR forgiveness. You will potentially have tax consequences. You do want to plan for it, especially given what we've seen in terms of changes to student loan relief over during this administration. But you probably won't ever have to pay it. We just want to be prepared. And forgiveness status. So like what's happening right now? Is anybody getting anything forgiven? Not that much. Okay, so anybody who is on save, you are currently in a forbearance, they're not taking payments, they're charging you interest, they're also not processing forgiveness. So you really are stuck if you are in save. And if you think that you are potentially eligible for forgiveness, meaning you've been paying for decades, you need to get out of save so that you can get your forgiveness. Under the pay and ICR plan, these are in quasi-frozen status. They are taking payments. Those payments do count toward your forgiveness timeline, but they're not processing forgiveness. And you will need to switch out of these plans by June of 2028. So if you're not going to get forgiveness before then, it might be worthwhile to just pick the IBR plan instead. Again, pay has an income hardship requirement, so you also need to check whether you're eligible. ICR does not, though. Everybody can get into ICR. It just sometimes is super expensive and is not a great plan. IBR, this is the only forgiveness plan that was created by statute, right? So it is still in effect. Things are still working. You can make payments under IBR. They count toward your forgiveness timeline, but processing forgiveness is stalled. And there is a current court case trying to get them to reignite the forgiveness processing process. And for now, IBR does not have an income hardship requirement. It used to. They got rid of that in the One Big Beautiful Bill. It was one of the nice things that came out of that. One of the only nice things that came out of that. But so everybody who has loans right now, you are going to be able to qualify for either old or new IBR. So this is an income-driven repayment plan that's available to you. It's just a question of whether you like the monthly payment. And then the new kid on the block, repayment assistance plan. This is not available yet, but it will be the only income-driven repayment plan that is available for loans after July of 2026. So like I said earlier, if you take out a new loan or if you consolidate starting in July of 2026, this is the only income-driven repayment plan you will have access to. You'll also have access to standard repayment plans, but that's really like a 10-year payoff, and that usually is kind of aggressive for most of my clients. In terms of what does the payments look like, the lowest amount that you could pay per month is $120, and you pay up to 10% of your adjusted gross income. Your AGI is basically your gross income minus certain deductions like retirement contributions, HSA contributions, healthcare premiums. And so it won't be your gross salary, but let's say you had an AGI of around 125,000. That means that you're making more than that, but this is post deductions. You would have a monthly payment of over $1,000 a month. These are often not great numbers for a lot of people. However, at lower income levels, the percent of your AGI is also lower. So it's kind of a sliding scale going up to 10%. You get $50 off of your payment amount for each dependent. So generous. And right, the interest is subsidized. This is one of the biggest benefits of the WRAP plan. If you are planning on eventually paying off your loans and you just need some breathing room in the beginning, if you can afford the WRAP payments, that can be a powerful plan to make sure that your balance doesn't balloon while you are making low payments on what really should be, right, much larger monthly payments to kind of cover all of the interest. WRAP takes 30 years to get to forgiveness, which is why most people won't qualify because they'll pay off their loans before 30 years are up. And the other quirk is that WRAP doesn't play well with other income-driven repayment plans. So whatever your payment count is now in terms of the eligible forgiveness payments, you're going to be able to carry those over to the WRAP plan. However, if you are in WRAP for any amount of time and you switch back to IBR or you switch to a different income-driven repayment plan, you cannot count those WRAP months. They're basically saying, no, the time you spend in WRAP doesn't count toward anything else. So you also want to be thinking about that if you're, ever planning on kind of switching back and forth between your plans. Now, there were some questions about the IDR payment count adjustment. They should be done with this. And all that's happening now is people are fighting about whether they did it right or not. Your IDR payment count is basically the number of eligible payments you have going toward your income-driven repayment forgiveness timeline. right? So before, student loan service providers were terrible about sending people their bills, letting them know whether the payment, was eligible for their IDR plan. And so there were a lot of payments that did not get counted. Those were adjusted and included in the payment count adjustment. Everybody should have gotten credit for those wonky payments, including payments on FFEL loans, which previously were not counted toward income-driven repayment forgiveness. So that was very powerful adjustment that they made for anyone who consolidated FFEL loans into direct loans during the magical time period. We talked a little bit, right, about the consolidation. Any loans that were consolidated between April of 2022 and June 30th of 2024 got the highest payment count across all of the consolidated loans, right? So if you had one loan from undergrad that had 20 years of payments, and you had a brand new loan from graduate school that had 3 months of payments, and you consolidated them together, they treated the consolidated loan as if it had 20 payments toward forgiveness. This was a super powerful relief. It's not available anymore. But if you did it during that time period and you are confused about whether you got all of the payment counts adjusted appropriately, this might be something to explore with the FSA Ombudsman to make sure that you're getting all of your credit. Now, if you do a consolidation, they will take the weighted average of the payments across all of your loans and give you some adjusted amount. You can check your count on studentaid.gov on your My Aid dashboard. When you're signed in, you can go to that link. These are all going to be included in the follow-up email that's going to come later tonight, along with the recording. So you'll have all of these links to be able to check your numbers and make sure that the Department of Ed gave you credit for everything you deserve. And like I said, this was some really powerful relief that, kind of took consolidation and made it a superpower. I had a client who had $370,000 of student loan debt forgiven 4 years after law school because she had some old undergrad loan that she had made some payments on earlier in her student loan journey, and she qualified for immediate forgiveness. It was a brilliantly happy day. And, I think this is why you want to be paying attention to what's going on in the student loan world. Every now and then, there are some powerful steps that you can take, but you at least want to understand what steps are available so you can really pick the best strategy for you. So before we go into picking the best IDR plan, let me go back through some of these questions. I know there are a lot of questions that came through while we were talking about the income-driven repayment stuff. So let me do this while you guys scan that amazing slide on picking the best IDR plan for you. Okay, we did charity. Okay, yeah. So charity, we talked about you consolidated your federal loans last year, but it seems like you're only paying interest on this right now. You are likely in save if you're only getting charged, if you're seeing just kind of interest accruing every month. If you are not getting a bill, if you are getting an actual bill, then you may not be on Save because Save isn't actually charging anyone anything. They're just tacking the interest on. So I would need to know which repayment plan you're on right now to be able to, kind of advise further. We talked about Whitney's lump sum payment. I was on, okay, Benny, I was on IBR for 14 years and then consolidated for SAVE. So does that mean I no longer have 14 years of payment? So it depends on when you consolidated. If you consolidated during the magical time period, all of those payments transferred over. If you were making payments on, you really shouldn't have been, I know you said that you had some FFEL loans. I imagine you weren't making payments under IBR because FFEL didn't used to qualify for IBR. So the IBR payments are supposed to transfer over. If you were in IBR, you're not supposed to lose those payments, even if you consolidate. That didn't used to apply to public service loan forgiveness, but I don't think that doesn't sound like it might be applicable to you. So you should still have 14 years of payments under your belt, and we should definitely want to check the payment count that's reflecting for you on studentaid.gov to make sure that you're getting credit for all of that. JT, mix of unsubsidized and grad plus loans. Yeah, see, we have some interest rates up above 9%. I'm telling you, these are usury rates. Okay, so JT, if you are planning on repaying your loans in full, You don't have to consolidate to refinance. And given your interest rates, you are very likely will want to refinance into the private market because you are going to get way better rates, especially now as interest rates are dropping. That being said, if you think that there is any potential chance that you may not stay in Big Law long enough to get your student loans completely paid off, you can take a middle road and take some of the highest interest loans and refinance those, but keep some of the lower interest loans in the federal world while you continue to make payments on them. But that way, you won't have your entire student loan balance in the private world where you can never qualify for an income-driven repayment plan or deferment or forbearance or anything else. When you haven't started at the firm yet. And so I would want to make sure that you really love it and that you are ready to stick it out for the entire term of your repayment before you sign up for something that's super aggressive like that and, kind of lose all of the federal protections. Uh, yes. Okay. When he's in save and interest is now accruing. Yes. Okay. The taxes on the amount of loans forgiven. What does that look like? Krista, that looks like whatever your tax rate is in the year that the loans get forgiven. And remember, the forgiveness amount will be added to your income. So let's say you are in the 12% tax bracket because you make less than $123,000 a year in terms of your gross income, and then you get $100,000 forgiven in that year. That will bump your income up to $223,000. And so for that, for the forgiven amount, you're actually going to be in a new tax bracket. You will be in the 24% tax bracket. So it'll be taxed at 24%. So it really does become a combination of what is your income tax rate in the year that the loans are forgiven when you include the forgiven amount in your income for that year. So it can be pretty high and it can be, it can be a bill. That being said, having $100,000 forgiven and having to pay a $24,000 bill is better than having to pay a $100,000 bill. So that's also something to consider, but that would give you kind of a sense of how much you want to save up for. Yes, the loan simulator on studentaid.gov is not always accurate. Thank you, Benita. They are having trouble on there updating their system. So I have a couple of other resources that I'm going to send to you guys where you can run some of these calculators. Okay, how does a married couple qualify for married filing separately? This is a selection that you can make, but you do want to work with your accountant to figure out whether it's a selection that makes sense for your family. So this is literally just something that you elect at the federal level, but the student loan people will basically treat you as separate from your spouse. So it'll just be your income that determines what your monthly student loan payment is. What I often find is it really is couple dependent, whether you're going to save more in taxes by filing jointly, or whether you're going to save more with respect to your annual student loan payments by filing separately. So have your accountant run the taxes both ways and then compare the savings to the savings that you have by lowering your student loan payment. Um, Okay, so she's a solo working attorney working part-time, primary income source. Yes, Krista, that would absolutely make a huge difference. If you have variable income or if you have lower income than your spouse and you're the one that's carrying the student loan debt, you can absolutely reduce your student loan payment by filing separately. I would suggest that you talk to your CPA and make sure that you wouldn't necessarily miss out on some other tax savings with respect to married filing jointly. I'm also not allowed to give tax advice. So if there are specific things that your CPA has told you with respect to California taxes, that California taxes are not relevant for your federal student loan payment, right? They're looking at what you're sending in for your federal taxes. Now, I imagine you have to file the same status between federal and state, but definitely something to chat with your CPA about. Another question, is the consolidated federal loan from undergrad to law school based on taking loans from undergrad date? Under the old versus new IBR disposable income. So if you took out any federal loan before July of 2014, you will be in the old IBR world. So they don't necessarily look, it's not like the new loans can get new IBR and the old loans can get old IBR. They're looking at you as a borrower. And so when you put in kind of all of your loans, that's going to tell you whether you are a new IBR or an old IBR person. They seem to have included my undergrad payments in my law school loan payments. Even I paid off my undergrad loans in 2016. Ooh, Benita, maybe don't mention that to them. Okay. There's a lot of processing stuff going on. And when processing errors are in our favor, we want to see how far we can get with that and maybe get some stuff forgiven ahead of schedule, if it's possible. Does it make sense to switch from pay to IBR now? I have 10 years of payments and my payment has stayed the same since 2020. I would probably not switch from pay. Pay is like a really great plan to be in. They may try to, ramp up when they cancel pay. Right now, pay is going to be around until July of 2028. That is the latest that you will be able to switch out of. That is the last, kind of month that you'll be able to be in pay, and you're going to have to switch eventually. But switching will also require that you recertify your income. So if you have had, an income jump and you have not had to recertify your income, right now, nobody should have to recertify their income until at least February of 2026. I would definitely not switch to IBR until at least you have to recertify your income because the payment very well may change. It may not, depending on if you're an old or new IBR. Um, but pay is a pretty good plan to be in. I would try to stay in it as long as possible. Oh, great. Charity, you're on pay. Wonderful. Pay is awesome. I love that plan. What's the minimum percentage change that would make refinancing worth it? We are usually looking at about a point drop, right? Minimum, because there may be some transaction costs. Now, all that being said, if right, you have to deal with the filing, you have to deal with all the servicing. For many of my clients, this is a headache that they don't necessarily want to deal with, every 6 months in terms of refinancing their loans. So you do want to just make sure that you are recouping the transaction costs over the time that you would do the refinance. And the rule of thumb is, we want to see at least a point drop. Now, if you find a student loan service provider that will refinance for you and not charge you any refinancing fees, and maybe you get a sign-on bonus, do it as often as you like. There's no limit on refinancing private loans. Banks like people borrowing money. They like that a lot. And you can pit them against each other. So, for that kind of refinancing strategy, it really is about how much can you handle and are there any transaction costs involved? Benita, yes. Say nothing. Let us benefit from some of these administrative issues. Okay. For question from Jean, how do you view your number of payments towards the 2025 year forgiveness? I'm on student.gov and I can't see the loans, but nothing about number of payments. So there is a link if you actually want to type in this link, Jean. Hold on, let me go back to there it is. Make sure when you're signed into student.gov, uh, type in that HTTPS and it should take you to your payment count summary. I will say studentaid.gov has been a little wonky over the past few months. Sometimes the counter is available, sometimes it's not. It's caused people a lot of heartache and heartburn when it goes away, but it does usually come back. So this is, kind of one way to try to back end your way into the payment count summary. And from Deirdre, if you are currently in SAVE, is there any way to switch into a different program, or are we simply stuck until the decision comes from the court? Ah, I'm so glad you asked, Deirdre. This is coming up on what do we do when we're stuck in SAVE? So hold that question. In terms of you had this slide up for a while, picking the best IDR plan for you, right? This is basically kind of like a cheat sheet. You want to be making sure that you're looking at any plans that you are eligible for and what the payments are under each of the plans, right? So not everyone is eligible for pay, not everyone is eligible for new IBR, but everyone is eligible for ICR and RAP. And so you want to check the payments under all of those different plans to see, can you manage the monthly payment amount given what your current income is? You also want to figure out how many more months of payments do I have ahead of me, right? How many payments have I gotten credit for under the payment count adjustment? So, how many years do I have left? Because that can make a huge difference about whether there's still going to be a balance to be forgiven at the end of the day. And then, right, this question has come up a little bit, like, should I just move to IBR now? Should I just get out of what save? Should I get out of pay? Should I get out of ICR, wherever I might be? IBR is the most certain path to forgiveness because it is harder to change the terms of this plan. This administration has already tried to change some of the terms of the pay as you earn in the ICR plan. They weren't really able to do that, so they just got rid of them. Certainty is going to be IBR if you're going for forgiveness. That being said, IBR can be one of the more expensive plans. So you do want to be balancing, right? How confident do you want to be that this is something that will be around later versus how much money do you want to be shelling out right now while people are still getting their ducks in a row? Okay, many of you are stuck in save limbo. It has been so frustrating. It's been over a year now that the courts have been mucking around with this plan. And so thinking about what to do, it really depends on where you are and what other financial obligations you might be balancing. If you are close to forgiveness, meaning that you have something like less than 2 years, right? 24 more payments that you need to make, I would highly consider switching to IBR sooner rather than later because these months are not counting toward forgiveness. You're basically just spending time not paying money, but also not moving closer to forgiveness. And if you don't have that much time before you reach your forgiveness endpoint, that might be worth it rather than waiting around another 6 months, losing another 6 months of your life, and having to tack on another 6 months of payments because you kind of stuck, were hanging around in save. That being said, if you have enjoyed not making student loan payments and you have other financial goals that you are working on, if you are shoring up your emergency fund, you are paying off high interest debt, right? Credit cards, personal loans, anything that is, kind of above 10%, then you might want to ride out the forbearance until you want to make your switch, right? Whether you're going to switch to pay or ICR or IBR or eventually wrap. Right now, nothing is due. So if you like that and you have better uses for that money, then you can just stay stuck in your save limbo and really not do anything until you absolutely have to, which the courts will tell you when. And again, right, if you prefer certainty, then if you are sick of coming to these webinars and learning about all the new rules and you want to switch to IBR, you might have a higher payment, or, right, you could also refinance. You could get out of the federal student loan game altogether, pay them off, right, come up with a repayment term that works for you. But all that being said, you just want to be, making sure that you're paying attention to what's going to feel emotionally the best. Even if it might end up costing a little bit more money, sometimes that extra cost is worth it for the certainty. Again, if you guys have questions that I don't get a chance to get to today, remember you're going to have access to me on my Voxer office hours. What I would suggest is that before you send in your question, spend a little bit of time tracking down your loans and your payment history. Make sure that we know, kind of what is studentaid.gov saying. Did you have anything, on your credit report? If you don't have private loans, don't worry about your credit report. If you're just doing federal, studentaid.gov is going to have all the information that you need. But you want to have a list of your loan types, the total amount that you're paying, your monthly payment, and your payment plan. I'm going to be giving you links to a number of my favorite online calculators. Some of them have had to go through some shifts because everything keeps changing, but that will help you determine which repayment plan might work best for your budget and your career path, and also, right, obviously your emotional health. You can take a look and see what a refinance balance would cost over time. I know some of you are already considering that. You definitely want to shop the market, look out for those sign up bonuses. And remember, you don't have to necessarily refinance everything altogether. You can refinance portions as it makes sense for you. But of course, right, with any plan, you're going to be checking in periodically. If you are anything like me, you will have a dynamic legal career, and one day you may not even be practicing law anymore. So you want to be thinking about that and how does that affect, kind of your repayment strategy over time. So for public service loan forgiveness, do I have anybody pop in the chat if you are going for public service loan forgiveness? If this is something that you are aiming for, if you are working for any level of government, a 501c3 or other PSLF eligible employers. Okay, perfect. Yes, we do have some PSLF folks. Amazing. If you are not already in the PSLF Program Support Facebook group, you need to go get into that group. It is the best resource for real-time support on maneuvering the Public Service Loan Forgiveness Program. There are people in there that have their payoff stories. These are the only folks who are getting forgiveness right now, and they're getting it every week. So it is happening. This is still an effective program. But so if you are not in this Facebook group, jot that down. This will be in the follow-up email, but I want to make sure that you are getting the best support because public service loan forgiveness is so frustrating, but it really can be such powerful relief, right? For anyone who's not familiar, public service loan forgiveness is basically the golden goose of the student loan world. It is 10 years of payments working for an eligible employer, and then all of your loans are forgiven, and there are no federal tax consequences. So it's really powerful, but you got to put in the 10 years. Right, so you want to make sure that you're satisfying all of the criteria, which means you need to have the right kind of loans. So you want to make sure that you have direct loans. Those are the ones that are qualifying for public service loan forgiveness. You also want to be working for an eligible employer. There is a PSLF tool on studentaid.gov that you can basically search by the EIN number of your employer. And make sure that you are working for one that qualifies for public service loan forgiveness. I will say there is a proposed rule change right now that is looking at changing the criteria for who is an eligible employer. It has not become law yet, but it may in the future, and that's something that you may want to consider. There's a lot of chatter about this in the PSLF Program Support Facebook group, so I would definitely suggest checking out there and seeing if your employer might be on the edge about whether they will remain eligible or not if this new rule goes through. The third step is making sure that you are in the right repayment plan. Only certain repayment plans qualify as eligible payments for public service loan forgiveness. That is any income-driven repayment plan, all the plans we've been talking about, or the 10-year standard. People sometimes get confused between standard repayment and 10-year standard repayment. If you consolidated your loans at any point in time, you very likely are no longer on the 10-year standard. You are on some 20 or 30-year standard repayment plan. 10-year standard is for loans that are something less than like $10,000 in terms of their overall balance. So for many people, if you've been on a standard repayment plan, that may not be an eligible payment. So you want to make sure that you've been on the right repayment plans. And then you want to be submitting your employer certification annually, making sure that all of those payments that you've been making are checked off as eligible. There's a fabulous PSLF counter on studentaid.gov that does seem to be working. And you can find that in the same place as you could find the IDR payment account adjustment. And then lastly, after you make 120 qualifying payments, then you can apply for forgiveness. It is happening, as I said, there are people getting their loans forgiven every week as they cross the 120 finish line. For people who have been stuck in SAVE, those months did not count, right? For the past year, those months did not count toward PSLF forgiveness, even if you were sending money in, which is super frustrating, and I'm so sorry if you did that. However, there is a buyback option. It's a process you have to apply for, but basically what that means is for this SAVE forbearance, you can buy those months back by going through the process, putting in the application for buyback, and then sending them the money for all of those months that they did not count, where you should have been getting credit, but you didn't because of the forbearance. And this is taking forever, but it is also something that is happening, and they are processing those applications. It just can take up to a year. So yes, we do have some PSLF folks, or we have family that is in PSLF, and 4 years of credit toward PSLF. Amazing. 6 years to go. Right. And a lot of the things over the past few years did make it quicker for public service loan forgiveness, to be able to happen for people. We used to not have the right kind of loans. If you had an FFEL loan, you didn't qualify for public service loan forgiveness. But if you consolidated that into a direct loan, now it does qualify. Similarly, people were on the wrong repayment plans for many years because student loan service providers were terrible at telling people whether they were in the right plan for public service loan forgiveness. They corrected that and just gave people credit for payments on any plan, during at any time period that was eligible for PSLF. So you should see a higher payment count than you otherwise would have. And because so many more payments were eligible, we have seen people crossing that 120 eligible payment line faster and faster. So that's definitely something to check on the studentaid.gov website. So for example, during some of this magical PSLF adjustment period, I had a client who had over $287,000 of student loan debt forgiven 3 years early because he was able to get credit for some of those earlier payments that were deemed ineligible under the old rules. So really, paying attention to some of the changes and some of the relief that we got under the Biden administration, making sure that's been applied appropriately can get you closer to PSLF even faster. Okay, any questions popped up related to PSLF before I get into the flexible, the repay your way, which is really just balancing a lot of these different criteria. We are also coming up on our 90 minutes. So if you guys have remaining questions, feel free to pop them in the chat, regardless of what the topic is. I want to make sure that you get answers to your questions, but you'll also have access to me via Voxer, where you'll get, you already saw the link, but you'll also get that where we can chat even more later this week. But so as we are wrapping up, right, the repay your way, this is really just kind of I've got student loans. I'm making some money, but I'm thinking I might want to pay them off. Maybe I'll go for forgiveness. What do? I don't fit squarely into the clear guidelines of, repaying them as quickly as possible or forgiveness being the clear path. We want to take a look at your overall financial picture. We want to assess how do you feel about your student loan debt? How do you feel about being aggressive versus not so aggressive? And we want to leave you some flexibility to be able to manage your student loan debt along with the rest of your life, right? So that's what I'm thinking about when I'm trying to put together potential strategies for my clients. We want to be thinking about the interest rates, right? Are you, generally speaking, you do not want to pay down student loan debt that has an interest rate below what you could potentially earn in the market or in a high yield savings account. I had some loans. I graduated at a magical time and I consolidated my federal loans at 1.75%. That is unheard of today. We saw some of that during the pandemic. But that being said, if you have really low interest student loan debt, then you can just leave that federal and pay it off, on whatever schedule. But if you have higher interest, which is what many of us are dealing with, then you want to be looking at those interest rates. Also, there may be relief programs through your employer, even beyond forgiveness programs. When I was working for the Securities and Exchange Commission, they participated in the Federal Student Loan Repayment Assistance Program. So I got an extra $10,000 that just went straight toward my federal student loans every year, right? It was kind of just like part of my compensation package. Of course, I had to, work at the agency longer. There are requirements and all of that, but it was definitely helpful on my student loan journey. And so you want to be thinking about, does your employer offer any relief programs? Does your law school offer any relief programs? Are there state level relief programs that maybe have broader criteria for forgiveness or payment assistance, maybe if you're working in a particular sector? And then, of course, other income, right? Will you have some sort of windfall later in your life where you can consider using the value from those future investments to wipe out the remaining balance of your student loans? Many of us think about our student loans as something that we have to do every single month, right? On this 20, 25, or 30-year slog. But you really can make a lot of headway by making large lump sum payments, right? Knocking down that principal when you can, when it makes sense for you and your family, to really be able to attack the overall debt. I did have some questions pop up. I'm going to prioritize those rather than my slides because I'll go through everything. But okay. So going up to Benita, my sister is past the 10 years and trying to buy back 7 months. She has contacted Mohila and even Ed. Is there anything she can do to expedite things? Sadly, no. The buyback is taking a really, really long time. I would suggest that you have your sister join the Public Service Loan Forgiveness Facebook group to get up-to-date information on timelines for people's buyback process, and also to the extent that there are any other, potential strategies or backdoors that people are accessing. One thing that she could do is reach out to her congressperson. So, a senator or their congressperson at the House of Representatives, they can sometimes move the Department of Education along on the buyback process because it's really Department of Ed that is managing that, and they just don't have any staff right now. But that could potentially help move her to the front of the line. Is it possible to switch loan providers? I have family members with Mohila and they are having issues. Yeah, Mohila is terrible, but they're all pretty much terrible. So it's kind of this constant through line that student loan service providers are terrible. You can switch student loan service providers when you consolidate. You're able to select what student loan service provider you want, but moving your loans just kind of willy-nilly is not really something that you can do in the federal world. For PSLF buybacks, what amount will each payment be? The amount due at the time of the month you are trying to buy back, or whatever your payment is in the month you are in at the time you are trying to buy back. So the buyback is based on what your income-driven repayment would have been in the month that you are buying back. So if you see a large income jump 3 years from now, and then you put in your buyback application, you would want to also submit your income from the months that you're buying back if it's very different, because that's what they would use. They basically are trying to like true up, what you would have paid in those months. Oh, yes, this is so great seeing you. Is there a difference between AidVantage and Mohila? No, they're both student loan service providers. Mohila is generally the student loan service provider that manages the public service loan forgiveness program. So if you are part of that program, the federal government moved you to Mohila when Mohila was managing that process. Mohila is no longer managing that process because they did a terrible job. And so it's back with Department of Ed. So now, anybody who you can be with any student loan service provider, but generally speaking, if you were ever in the PSLF world, you probably ended up at Mohila. Question. We are paying my husband's new student loans out of pocket, but he has prior loans. Do we need to designate a repayment plan before July 26 when he graduates in 12/26, or can we wait until he graduates? You can absolutely wait until he graduates. All of the plans that are available in July of 2026 will also be available in December of 2026. That being said, if he takes out any additional federal loans after July of 2026, then he could limit himself to only having access to RAP for all of his loans. So you don't have to pick the program now, and he's probably in school deferment, I would imagine, if he's currently in school. So maybe you're paying the interest out of pocket, but you're not actually being charged anything. But he will have access to old and new IBR in December of 2026. So you'll still be able to get access to those plans. One thing, Melissa, that I want to double check is whether you will be able to enter pay as you earn after July of 2026. I know if you're in the plan already, you'll be able to stay until June of 2028, but I'm going to double check to make sure that you will be able to enter the plan after July of 2026. So great question. Oh, yes. No, no. Advantage and Mohila are different companies. They're just equally terrible. Uh, okay. Yes. Whenever my clients are consolidating, they're like, which student loan service provider should I pick? I'm like, there isn't a good one. I don't just pick whoever. Do you have someone who has your old records? That's usually helpful so that they don't have to transfer records and nothing gets lost in the way. Okay. Repay your way anecdotes, right? So these are some creative ways that you could think about that, not necessarily my clients, but folks out in the student loan world have taken care of their student loans, right? Using a HELOC, right? Maybe if your parents happen to have a lot of equity in their home, they took out a low interest fixed rate HELOC to pay off their daughter's private student loans. And right, that was not necessarily in the personal finance world. You don't really want to trade secured, right, home equity debt for unsecured student loan debt. But they really wanted to help their daughter out and they had the equity. So they were able to do it. And then, of course, the daughter increased her life insurance to cover that HELOC payment just in case something happened and she wasn't able to pay them back. Right. But similar strategies like cashing out, using a cash out refinance on maybe an investment property to get some money out to wipe out your debt. Right. These are just kind of restructuring debt strategies that you can think about as you continue to build assets over your financial journey, making sure that you're not treating your whole universe of student loans exactly the same. We had the question come up earlier about, hey, if I'm going into a law firm and I want to pay off my loans as quickly as possible, should I just refinance everything? Maybe you refinance some of it, but not all of it to give yourself a little bit of flexibility. Or you remain aggressive on paying down the higher interest loans, but not so aggressive on the lower interest loans. Right. Like my personal journey was I had much higher interest private loans than the interest on my federal loans. So I prioritized making big lump sum payments and extra payment every month toward my private loans. And I let my federal loans sit there at 1.75 and I paid the minimum. And I almost didn't pay them off, but then I got I'm semi-retired now and I didn't want to carry them around. So that was like an emotional decision. That was not, the best mathematically efficient decision, but I'm super happy with it and I don't regret it, right? Or thinking about, are you going to have other investments that grow over time faster than your student loans are growing over time, such that you can use that in the future to kind of wipe out the debt in one fell swoop? But those are things you definitely want to be working with a professional on, right? There's potential, right, investment projections you want to be doing. You want to be looking at tax consequences. But all that being said, there are some more creative ways to be attacking your student loans. It's not just the same payment every month for the rest of your life. I'm quickly going to go through options for default, just in case anybody reviewing the recording is, kind of stuck in a potential default. There are two ways to get out of default. You can consolidate your defaulted loans, or you can rehabilitate them. There's a lot of information about how to get out of default on the studentaid.gov website, and I will also include the link in the follow-up email. You may have to pay some money, but it really will get you back into the good graces and able to take advantage of both income-driven repayment plans and potential forgiveness. Right. So in terms of making a plan, right, all of these strategies are very personal. It really does depend on where you are financially, where you are with other obligations, and your career trajectory, because especially for income-driven repayment, it's based on what you make. So it really does depend on, kind of what is your career going to look like. Big warning sign, do not consolidate after June of 2026 unless you are absolutely sure that you want to be in wrap or you're going to be repaying your loans as quickly as possible. You want to be comparing those payments under the different plans, including plans that are not income-driven repayment. There are standard repayment plans, extended repayment plans, graduated repayment plans. Those are still viable repayment plans. They just don't qualify for forgiveness. So, it keeps your loan federal, but maybe gives you some relief. And I am a big believer in making sure that you are choosing flexibility whenever possible. There are very few doors that you can go through that will close off a world to you forever. Refinancing federal loans and turning them private is one of them. So you want to make sure that you are retaining flexibility when it makes sense, but sometimes it's worth it to close the door. Oh, isn't this so simple? Did we have more questions that came up? It's not simple. It's not easy. I understand. Some people don't even know how much they owe. I was like that. I liked avoiding my student loans for a lot of time. But let me make sure that I'm getting to the questions that came in through the chat while we are finishing up the material. And if you guys, even beyond the Voxer, if you would like my eyes on your actual loans, I do offer a student loan repayment program where you get my one-on-one help and you get to meet with me. We have 2 sessions live here on Zoom where we can go on studentaid.gov together. We can check everything out. We can figure out what your action plan is going to be, run the calculators together. That is the plan that I've been offering for now almost 2 years. And it's the plan that most of my clients who got that insane forgiveness went through in order to figure out what was going to be the pathway for them. But I'm happy to answer all the questions on Voxer on Friday and Monday to the extent I'm not able to get to anything today. Let's see. Oh, no, okay. If we want to pay extra toward our loans and ultimately pay them off faster and pay the least amount of interest, should we apply any extra money toward the principal or loans with the highest balance interest rate or spread the love among all the loans? You definitely want to make sure that you are talking to your student loan service provider so that when you send extra money, you are sending it toward the principal. And I would absolutely send it toward the principal of the highest interest loan, right? That's a combo hit of knocking down the most expensive loan, right? The one that's charging you the most interest, and also making sure that you are getting through that loan the fastest. You will probably have to contact your student loan service provider because many of them, when you send extra money, they just apply it to future payments instead of knocking down the principal because they're terrible. So you definitely want to make that call, but knocking down principal is a great way to get through your loans faster. Okay, reading this question. My sister tried submitting an IDR application earlier this year, but it is still processing, and she is currently stuck in the standard repayment plan, though it's currently a bit lower because I consider consolidate. Oh, So how should she address that application? Should she submit another one? Yes, if she has been stuck, if she did the IDR application before April of this year, I would absolutely submit another one. The applications are processing much faster, and if she submits a new one, it's not going to muck anything up. They're not going to be like, "Oh my God, we have two applications. What do we do?" They're just going to take the new one and they will process it faster. So they now have electronic processing going on. If she's comfortable connecting her IRS information, that is the fastest way to get an IDR application approved right now. So I would absolutely have her reapply. What interest rate is the max? We should just let them sit there and pay the minimum if they are federal. Ooh, that's a good question. I mean, some of it, right? Some of it is emotional. I think in terms of what interest rate is the max, we should just let them sit there. I mean, I would probably say anything under 3%, I would feel weird paying extra toward at any point in time. Maybe even as high as anything. Five is a little high for me. I would definitely say three or below. I would be perfectly fine just letting that sit. That's practically free money, right? One of the guidelines that you want to think about is, am I beating inflation? Right? Can I make more of this money with having it sit in a high yield savings account than the interest that's accruing on my student loan? Right now, high yield savings accounts are running roughly 4 to 4.5%. So that's kind of one of the markers that you can use for determining, does it make sense to throw more money at this loan, or does it make sense to just let this loan ride out because I'm making more just by having money being fairly safe and sitting there? Okay. Oh my good. Oh, Ashley, I'm so excited for you. If you guys didn't see in the chat, Ashley took my student loan repayment course a couple years ago and consolidated during that magical time. It was so magical. And she was recently in a position to purchase a home in large part due to the counseling she received. Oh, Ashley, it has been lovely to support you over these past few years. And for so many of my student loan repayment clients, there have been so many changes. Yeah, we have to do a refresh every now and then. But that's one of the benefits when you sign up for my one-on-one program. I am always happy to answer more questions that you might have about your student loans because these are changes. And I take my one-on-one clients are very special to me. So they get a level of service that I'm unable to provide to the entire universe. But you guys will get a taste of it with the Voxer. Right. So more student loan resources. You will get these links in along with the recording with the follow-up email. Check out your stuff at studentaid.gov. I have even past Zoominars and interviews with tax folks and investment folks related to student loans. Also, Student Loan Planner is they offer paid services, but they have so many free articles and calculators. You're going to see that some of my favorite student loan repayment calculators come from them. That is a great website to go to for some more information on kind of how to think about your student loans. And then for free advice, you can go to freestudentloanadvice.org. This is a nonprofit that offers guidance on student loans. What I will say is that they actually do have some sort of like listserv where you can post comments. You're just not going to get, kind of immediate feedback. And I found that the interface is not necessarily as visually appealing or easy to maneuver as Student Loan Planner. But hey, for free student loan advice, not a bad place. So I hope this has been helpful. If you guys have any more questions, please feel free to pop them right into the chat before we have to sign off. But I've had a really fun time explaining all the student loan stuff. I'm going to drop some links in the chat in terms of where you can connect with me on LinkedIn and also to make sure that you have that link to the Voxer sign up. And for my one-on-one program, if you really would like some serious handholding in figuring out the best student loan repayment strategy for you, then you can sign up at jessicamedinallc.com/SLRP. But remember, come find me on Voxer later this week. And also, it's been a pleasure. I know there's a lot going on in the student loan world, but I hope that this has been helpful and hopefully we will all have a plan for our student loans moving forward.